Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Chris Larsen. Chris is the founder and principal of Next Level Income. He's been investing in and managing real estate for over 20 years. While still in college, he bought his first rental at the age of 21. And from there, Chris expanded into development, private lending, buying distressed debt, as well as commercial offices, and ultimately syndicating commercial properties. He began syndicating deals in 2016 and has been actively involved in over $1 billion of real estate acquisitions. And Chris is passionate about helping investors become financially independent. And in just a minute, we are going to speak with Chris about why and how he invests in cash flowing businesses like car washes in addition to real estate. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Chris Larsen. Welcome to CRE PN Radio.
Darren, great to be here.
Well, I'm so looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, Darren. So great intro. I really appreciate that. And we're going to talk a lot about different types of real estate and even some businesses that kind of layer into that. But I started off in college. I wanted to race my bike. So I went to school actually for engineering, went to Virginia Tech. But my passion at the time was racing bicycles, specifically road bikes. I was doing that. I go to class every once in a while. And in between my freshman and sophomore years, my best friend, my roommate, my training partner, Chris, passed away. I raced for another year after that. And I realized this is silly. This is not the most I could be getting out of life. And there's a lot of stuff going on in the sport at that time. And I got to train with people like Lance Armstrong. I got to race against that whole generation. So I got to know people that were going to Europe, and I was hearing the stories firsthand. And I tell people I'm lucky that I wasn't good enough to have to make some of those hard choices that some of my friends had to make, because I realized that even if I was using performance enhancing drugs, I wasn't going to be a great pro. And I sure wasn't going to drug myself to be a crappy professional cyclist. And the thing is, cyclists don't make a lot of money. Even if you're good, they don't really make a lot of money. And I always had this entrepreneurial streak. So after racing for another year, I made this decision to hang my wheels up, so to speak. And I said, okay, I'm not going to let an opportunity pass me by. I'm going to live life to the fullest. And the thing is, the reality in the world, and if you're listening, you know this, you need money to be able to take advantage of opportunities, whether it's an opportunity to invest, whether it's an opportunity to take a trip, whether it's an opportunity to put your child in the best school. All these things cost money. So between my, kind of entrepreneurship, as well as this desire to really, live life to the fullest, I looked at all these different investment options. I read 250 books, actually more than that, on investing, finance, real estate. I got an MBA in portfolio management. And along the way, I bought my first property at age 21 and built a strategy around real estate to help me achieve financial independence in a very predictable way. And we've since gone from small residential properties, single family rental properties, to multifamily syndications, to self-storage, car washes, hotels, mobile home parks. We have a debt fund as well, where we do basically hard money lending. private loans. So we have a whole spectrum, and we brought along a lot of investors along the way with us as well.
Wow, that's quite the history there as far as the different things you've done, and it sounds like you're a very goal-oriented person. I can only imagine with the bike racing and just the dedication it took to get to the level you were at, and the discipline. I'm assuming that paid off. Maybe it didn't sound like at the time with your school, based on the way you described you barely went to school, but
A little tongue in cheek there,
yeah,
but
yeah, yeah. No, I was gonna say but still, I have a lot of admiration for anybody that's really dedicated themselves to a particular um, you know, thing or a passion, and and then also had to make the decision as to whether or not they could continue. But that how those traits that got you as far as they did can transfer and help you in other aspects of life. So appreciate you sharing that.
no, I agree. Yeah.
So you mentioned you started with was it a single family? Is that what you started with in
Yeah, and
college?
bought a single family rental, and I think I saw you have a copy of this here as well, Darren. And I go all in. So if you really want to dive into my story, you can get a free copy of my book at nextlevelincome.com. Yeah, I talk about how I started with one single family rental at age 21, and I just kept going from there.
Got it. And since then, you've done multifamily, office, and was it self storage? Are those the
Yeah, so multifamily and self storage are kind of the base of our investment pyramid. Yeah.
okay? Um, and between those, is there a preference, or have you found them to be equally satisfying or profitable? Or
Yeah, I think, we guide ourselves by demographics and the fundamentals. And, if you look at kind of the framework that I've built out for our investment thesis, it's based upon demographics. So, where's the tide going? We're gonna have short-term movements, we're gonna have waves, on any given day or any given year. We've seen a lot of kind of ups and downs in the real estate market. We've seen interest rates rise, but the long-term fundamentals still persist in multifamily. And a lot of those same fundamentals cross over very nicely with self-storage. And one of the things is self-storage actually historically has outperformed during recessionary times. So maybe you ask me after the next recession which one I like better, but I'm definitely, if you ask, I say I always put my money where my mouth is. Multifamily is the absolute bulk of our investment portfolio, both from our investment group that we work with investors, as well as from a personal perspective.
got it. And did I understand you're also you've developed some of your properties? Is that correct?
So my wife is an architect, and my wife and I have built several spec homes. We have a residential development that we're working on right now. As far as the car washes are concerned, that, I imagine we may dive into in a little bit. We're building some of our own locations on that part. And even some of our self-storage facilities have expansion opportunities. But for the multifamily, for the self-storage, even for the car washes, we're basically running with a value add model where we're buying, established, stabilized properties. Development is a minority in our portfolio.
Okay, I just want to make sure I know that they, at least I looked a little bit on your portfolio there, and I thought, wow, that's some of those properties are significantly large, more than a couple hundred units, and the development of that's quite the task there. So I was just curious on that. Um, all right, so and you mentioned you have been syndicating how many since I guess 2016. How many deals have you gone full cycle with?
Full cycle. Oh, geez, I have to go and check here. At least a half a dozen. I'd say
Okay.
5 to 10 total full cycle deals at this point.
All right. No, that's an impressive resume, and definitely you've managed to get in and get out and make your investors happy. That's all good. So let's talk about how you transitioned from or saw the opportunity to start investing in cash flowing businesses in addition to real estate. Um, so what is the, or what's, how did you go from, I'm a real estate guy to now I'm investing in operating businesses?
Yeah, I think that's a great question. And, one of the questions I get a lot, Darren, is people say, well, hey, Chris, how did you make the transition to real estate? Because I spent 18 years in the medical device industry as well. And when I was in college, I was racing my bike. So kind of, I've always been doing typically multiple things. So my life always had kind of these dual areas that I was operating in, whether it was academics and sports, or whether it was a career and sports. I ran a developmental cycling team, or whether it is my medical device business and real estate. I've just always had a couple different things going at one time. So it's always been natural for me to have, kind of overlapping businesses or multiple endeavors to keep me. I don't know if maybe I get bored easy. I'm not sure what it is, but I think the first thing is I see myself as an investor. So I started off as an investor. I put together my strategy, and then I needed to fuel that strategy specifically with capital. So, for somebody that doesn't come from money, whose parents made, oh geez, they didn't make six figures combined while I lived, with my parents, and I don't know if they ever made six figures combined, except maybe in the very later years of their careers before my parents retired. But I needed a way to buy more real estate. So I said, hey, what's a career that I can go out in that is going to be stable, so I can have stable income coming in that I can put into a reliable, predictable strategy? Because I think first off, society, in my opinion, does young people a disservice by saying take risk early in your career. I think that's backwards. I think you want to take risk away early, have a predictable path to success. And then, specifically, if you're financially independent, if you don't need to work anymore and you're 30, 35, 40 years old, well, how much risk can you now take? You can take infinite risk as long as you don't damage, the kind of that principle and that initial equity that you built. So that was my strategy. I reversed what society told me. So I'm kind of a contrarian with respect to that. And then if you read my book, you may say, well, Chris, this is all about multifamily real estate. But if you look at Warren Buffett, you say, well, Warren Buffett, what type of investor is he? He's a value add investor, right? He buys companies and he improves these companies. And it's all based on Benjamin Graham's philosophy that he put together. So I read those books. I was gravitated towards these lower risk endeavors. And really, I look at a multifamily property, Darren, not as an apartment, but I look at it like a business, because that's how the IRS sees it. They say you're running a business and we're going to give you the tax benefits like you do a business, but you happen to get even better benefits because you have this real estate associated with it that has these terrific depreciation benefits. So, what we do in our value add model is we look to improve income revenues. We look to decrease expenses through improving our operations, which yields an increase in net operating income. And whether it's net operating income or EBITDA, a business, a property is sold on a multiple of that number. So if you look at a multifamily property and you look at a car wash, it's the exact same formula. It just takes different levers and different knobs that you have to pull. So if you look at multifamily and self-storage compared to, let's say a car wash or assisted living or even short-term rentals, which we have 2 short-term rentals here in Asheville, to me, those are real estate plays, but they're what I would call operating real estate. So you have this operating component of that business on top of them, but they're still simple businesses. There's complex if you deal with the people, but it's not as complex, I can tell you, as being in an OR and working with surgeons as I did for nearly 2 decades of my life. That's a very complex, very high stakes environment. So I like simple businesses. I looked at car washes for the first time nearly 10 years ago with my uncle. We almost bought one. I decided that, I still had my medical device business at the time and we were focused on apartments. So we passed on that opportunity. But a couple of years ago, talking with my partner and the opportunity in car washes, something had changed. And what had changed was that private equity was now interested in these businesses, because what we have seen here, and, and we've kind of alluded to it or discussed it at the beginning or before the show, is that everybody's searching for yield, because as interest rates have climbed and cap rates have lowered, that spread has shrunk and shrunk and shrunk, where there might not be cash flow where there was cash flow before. And investors, private equity groups are saying, well, where can we now get yield? And some of these operating real estate plays are close to real estate, if not have a large component of real estate. They're simple, they're scalable, which I talk about in my book. And when you scale them, you increase the multiple that you can sell versus what you acquire at. And we're seeing 50 to 100% increases in the premium that we get from purchase to sale when we package those assets.
No, I love the kind of the path, and I appreciate you kind of walking us through that. So let me ask you, I get that the numbers, uh, operating income and, whatever the multiple for a particular industry, would avail itself as far as the value, and the desire to increase revenues and decrease expenses to increase that spread. I'm,
Yeah.
I'm curious though, have you found that there's any expertise beyond that you've needed, or you've had to find others to provide for you, or how hands-on the actual operations of a company are you? Are you the CEO of those companies and you do all the hiring, or are you more of an investor in a business?
Great question. So let's speak specifically about the car wash business. So I personally own a car wash here locally in Asheville with just one partner. So we have it's called an automatic in bay. If you look at the car wash business, you have a few different kind of models. So take away like the detail portion, right? That's not really, that's kind of a separate section, because people aren't washing their car, having somebody detail it typically every single week, which is typically going to be $100, $200, $300. So talking about like self-service, where you go and maybe you have a coin operated machine and you wash your car yourself. You have in-bay automatic, which it's really like a big robot. You pull into a bay and that robot washes your car. It typically goes around your car. Ours is touchless. And then you have what are called express tunnels. And these express tunnels, it's basically a large tunnel. Shocker, express tunnel, right? It's a large tunnel with a conveyor belt in it. And that conveyor belt pulls your car through the tunnel and it washes kind of dirt with these little stations inside the tunnel. And it typically only takes 3 to 5 minutes to wash your car. So when we did our research, the car wash I have here locally, it doesn't have any employees on a day-to-day basis. It's all automatic. We've got the robots in there that are washing cars. Self-service, you don't really need a lot of employees there because people are washing their own cars. But the express tunnel model it's pretty simple in that you don't need a ton of employees, but you typically need about a half a dozen employees. And yes, that is the crux, Darren, of that model. So what we found is, if you want to go do this yourself and scale this model, there's a couple ways you can do it. One, you're a large operator and you already have a team built out. You just build new locations. Two, you work with an operator that franchises their model and they kind of give you the blueprint to do that. And that's a quickly scalable model, but you give up a lot on the back end when you scale in that manner. Or you build your own operating team, which is the path that we chose. And there was a lot to learn. So we brought in consultants. We brought in our head of operations that used to run a medical production facility. So if you think about car washes, there's really 3 components to being successful in the car wash business. One, having efficiently run machines. 2, optimizing chemicals. So you want to optimize, the concentration of the chemicals, even the spray angle of the chemicals, and the speed at which you apply those chemicals. And 3, people. So you want to make sure that you have an individual and somebody that runs that ran a medical production facility has those types of expertise. So it's not as complicated, but it still is a necessity to understand all those things. However, what we found, even though getting the best advice as we built out these teams and buying locations where we already had employees in place, now having over 100 employees on the operating side of this business, which that's not my primary focus. As you heard me say, we have somebody that runs that. I know where I'm good. And I'd rather hire somebody that's better than me at those things. I always joke that, I'd work, I wasn't smart enough to be an engineer. So I had to go and sell the components that these engineers developed and the surgeons used. But what we found is the industry, it's simple, and a lot of the technology hasn't caught up to where it could be. So CRMs, customer resource management tools, are not optimized. If a patient's credit card is declined, their membership might be canceled. Simple things like figuring out if you bill on a Saturday or instead of a Friday can enhance your the retainment of memberships. Operating more like Chick-fil-A, where we have well-dressed staff that are paid more than the industry average, that are taught how to sell and be polite to our customers or clients in the car wash, can rapidly increase memberships. I was just looking at our quarter over quarter numbers. Our memberships are up 75%. And what is that from? It's from basic sales, paying our staff well. And what we do is we add one more employee per location. That employee can focus on selling. This isn't a complicated sell, Darren. If you're washing your car a couple times a month and paying $50 and we offer you a membership for $30, well, why would you not take that if you can wash your car twice as much and pay about half as much? That's a good deal for you. And it helps us out because we have this consistent revenue that private equity groups really like on the back end, because we can show them that monthly recurring revenue, which is obviously very popular when it comes to a stable investment opportunity.
Yeah, I was going to ask you about the highs and lows. I'm kind of curious on, I think of a car wash. I mean, obviously, cars get dirty, need to be washed.
Yeah.
Where you're located, is there any seasonality to it?
Yes, good question. It's interesting. I just had an investor email me this morning, and her inquiry was, "Hey, why would you buy a car wash in Florida instead of a wash somewhere like Colorado, where you're going to have more storms and more need to wash a car?" What's interesting is, if it's bad weather, people don't wash their cars in bad weather. You wash your car when it's nice out after the bad weather. So there's absolutely seasonality. People wash their car less in the winter, and they wash their car more specifically during like spring, summer, when there's a lot of pollen out, right? So there's a lot of pollen. People might wash their car twice a week when there's a lot of pollen. And that, you want to wash your car when it's nice out, because you can kind of see and tell that it's nice. So we see seasonality, but we also see geographic seasonality. So our car washes are located everywhere from Maryland all the way down to Florida on the eastern seaboard. And, we're looking at locations significantly further west as we underwrite opportunities for our portfolio. But that's another thing that you can say, hey, we're going to hit a peak, say the first week of April in Columbia, South Carolina. But in Baltimore, Maryland, that peak may come a month later than it does in Columbia, South Carolina. So you have to be able to adjust and have systems that adjust for those peaks and troughs. And maybe you also adjust your selling techniques, right? Again, this isn't complex, but maybe that's when you add your additional staff, is during those peak times, and do that. And the big threat to this area is really saturation. So it's going to be about 15 years before this market is built out, but it's all local. So we want to make sure that we're focusing on well-placed locations or well-placed acquisitions. When we purchase those with traffic flow, it's a little less sensitive than when you're buying, say, a multifamily property where you want somebody to have an average income of $80,000. An area with an average income of $40,000 or $50,000 can do very, very well in this space. You just don't want to be right across the street from another wash necessarily.
Right. So you transitioned into the car wash, and if I understood right, is the kind of the value add plan, is that essentially what is the plan with the car washes? Are you looking for a future exit eventually?
Yeah. So if you look at just an individual car wash by itself, if you buy a car wash and you run it well, the margins are about 50%, really nice margins in the car wash space. Investors can see double-digit cash flow, which is really nice if you look at that compared to multifamily or self-storage properties. But here's the one variable that can be very appealing. So if we're buying at a 7 or 8x multiple from small mom and pops, and this is the opportunity, Darren. So if 85% of multifamily properties are owned by institutions, it's inversely proportional to the car wash space, where only about 15% of these express tunnel car wash locations are owned by large institutions or large operators. So that means 85% are owned by operators with 4 locations or less. So 1, 2, 3, 4 locations. If we can buy at a 7 or 8x multiple of EBITDA from those operators, package them into a portfolio of 50, 100, 200 locations, we can sell somewhere between a 12x and a 20x multiple of EBITDA. So again, you're seeing a 50 to 100% increase in the exit multiple. So if we just buy these car washes, implement our branding, our national contracts, our sales strategy, our proprietary software systems that we have, then we can do very well. But if you pair that with the opportunity to exit on the backside with those multiples, then you have some really, really exciting returns on the backside as well.
Yeah, that sounds exciting to go from 7 to 8 to a 15 to 20. That's a big jump.
Yeah.
On the time frame, do you have any kind of a time frame that you would expect to accomplish the packaging of and exit? Is there like a 7 to 10 years, or how do you look at the
Yeah.
exit strategy?
Great question. Great question. So if you heard me before, I mentioned that there's about a 15-year period where we're going to basically be built out in this space. So if you look at that and you say, all right, if we're selling a portfolio, a savvy buyer is going to want to run that portfolio for multiple years to take advantage of it. So let's say they want to run it for 5 to 10 years. Okay. We want to acquire, package, and sell our portfolio in the next 3-ish years. So 3 to 5 years. So so let's say 5 years was our initial timeline. We have about 3 years left. So in the next 3 years, we'd like to exit a portfolio of 150 or more locations.
Oh, that's awesome. And as far as I guess I'm trying to just decide on the value of a car wash, I'm assuming, is directly proportionate to the volume of sales. So it's not a matter of doors. Is it based on a traffic count, or when you're underwriting and looking for the opportunity to increase the value, is
Yes.
traffic count kind of the primary indicator of the opportunity?
Yeah. So if you look at a multifamily property, you're going to want to know what are the in-migration demographics. You're going to want to know what is the employment in the area, what is the employment diversity in the area. You're going to want to know the area median income. You're going to want to know all these things for a multifamily property. For a car wash, the metrics are going to be exactly what you said, Darren. You're going to want to see the traffic count, but you're also going to, what's interesting is you also want to see the traffic speed. So let's say you have somewhere where 100,000 vehicles pass by every day, but you can look on like the software we use and see that the average speed is 55 miles an hour. Well, maybe that car wash is right next to an interstate. That's probably not a great location. But let's say the average speed is 30 miles an hour. It's in an intersection and it gets a traffic count of 40 or 50,000 cars a day. That's a terrific location. Area median income, let's say it's 40, 50,000 plus. That's very reasonable for somebody that's going to pay $20 or $30 for a monthly membership. And then you also want to look at the saturation. So again, as I mentioned before, you want to see, are there other washes within, a mile of that area, 5 miles in that area? So most people will probably understand intuitively after I say it, the number one reason of if somebody goes to a specific wash or not is proximity to their residence or location at work. So we want to make sure that, we look at that area median income, the proximity to households, the traffic counts, make sure that those all meet our metrics. And then is the location that we're looking at, is it already going to be cannibalized by other locations? Yes or no? And then, if it checks all those boxes, the value of that wash is going to be directly proportional to the EBITDA of that property, to the profitability of that property. And then it's pretty simple math, because we can just plug in what we know to be our system that works, and it's predictable after we take over locations, and we can determine, if those numbers are going to work for us and our investors.
With respect to like multifamily, I mean, historically, NOI, you could just ballpark 50% is just a starting point. And hopefully that you're able to, lower you lower your expense, increase your revenue, and maybe get that, raise the NOI and lower the expense percentage. Um, in comparison, how would you, is there a ballpark starting point when you're looking at a car wash, what you would expect for, an expense ratio compared to income?
Yeah, it's actually not a bad number, the one you just threw out there, 50%. But really our metrics are driven by that membership growth. So that's where we've really found we can definitely make improvements on operating margins because of our national contracts. But if you take into account, like, why would we add a sixth employee per location versus the industry, or an employee versus the industry average of 5 or 6? Well, the answer is we're going to realize a significant value increase by increasing those memberships. And that's where, some of these smaller operators, they say, hey, a dollar saved is a dollar made. Whereas, we say, well, if we can spend a dollar and create $10, that's going to be a little bit more like, the way a value add multifamily investor thinks, where they say, I'm going to spend $10,000 to renovate this unit, but I'm going to create $50,000 in value from the NOI increase on the back end. So, even if we kept the margins similar, if we're increasing that revenue, 50+%, we're going to have a massive increase in value.
For your car wash business, are you doing like syndication, or do you have a fund, or are you doing this individually, or how are you going about raising the capital, or where? Tell me a little bit about that side of your business.
Sure. Yeah. So we're at 24 locations currently, and we're underwriting on a month-to-month basis, 10, 20, or 30 locations on a monthly basis. So we always have deals coming in on the car wash side, significantly more than the multifamily side. And what we've been doing to bring investors in, we have really they're funds, but they're small portfolios. So typically anywhere from, say, 2 to 5 locations. So investors get to participate and diversify, but they also get the benefit as we roll those locations up into the overall portfolio. So yeah, typically an investor like the fund, we're actually closing on 3 more locations here on Friday of this week as we're recording this. And that fund has 4 locations, and they're spread out between Florida and Tennessee.
Got it. So a little bit of a diversification as far as the
Exactly.
weather. You don't want to have everybody in the same dark, snowy town that you can't get any car washes done. So that's good. So,
Yeah.
so if you were going to give some advice to one of the listeners that's liking what they're hearing, what would be the first thing or what would you encourage them to to do to get started, or how would they go about, how would they best go about getting started in like the car wash?
Yeah. Yeah. So I think first off, if you're an investor, you need to come up with your own personal strategy that makes sense for you. So as you can imagine, Darren, I have investors call me and they say, Chris, I'm looking at this multifamily deal, this self-storage deal, and this car wash deal. Which one should I invest in? And that's not my job to provide an investor with that answer. Investor, if you're listening, you need to come up with your own personal strategy and say, hey, does this fit into what I want my portfolio to look like? If the answer is yes, and again, whether it's any of those different opportunities that I just mentioned out there, one, you need to understand, does the strategy make sense to you? Maybe you want to get into development. I know investors, they say, I want returns that are twice what you're doing, Chris. And I say, well, we don't have deals like that. Can you send me one? And they send me a development deal. So a development deal with no cash flow for 2 or 3 years is going to look significantly different from a deal that has, like our recent self-storage portfolio that we acquired at 52% loan to value and cash flow from day one. Like, that's a different deal. So you need to decide what you're going to invest in. If you say car washes make sense, you need to understand that a car wash investment is more of a business than real estate. And if you invest in something like car washes or senior housing or short-term rentals, make sure that you understand the operations, and your operator and your operating partner that you're investing with can explain that to you, and you understand how are they going to be better than what's already out there. So we walk through a lot of that today, right? So those are really important questions to ask. Also, make sure you understand the structure of the investment. So are you investing? I've seen car wash investments out there. They're debt offerings. So investors are investing in a car wash, but they're just getting paid a percentage on their money. So there's not any upside. I think we're fairly unique in the fact, Darren, that we allow investors to participate like they would in a multifamily property, where they get the cash flow from the deal and they get some of that upside, which again, if you're looking at increasing your exit multiple, 100% over what you went in at, those are exciting returns, out the other side. So, as an investor, if I'm investing in a business like this, I'm taking potentially a little bit more risk. There's more variables. I want that upside. Whereas if I'm investing in a multifamily property, that's a institutional, core asset that things like, life insurance companies invest in, pensions invest in. That's going to look a little bit different. And that's my last thing. If you're an investor, don't let the tail wag the dog. Don't look at the returns first. Look at them last. Make sure you understand the strategy. It fits into your personal portfolio. Make sure you understand who you're investing with, who the operator is, and then look at the returns. And you can get excited at that point. But if you just look at the returns and say, oh, the car wash returns that Chris is talking about are better than the multifamily returns, probably, but don't let that tail wag that dog.
No, that's really good advice. Hey, Chris, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. And when that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, your investors, the political environment, interest rates, however you would like to identify and describe what you consider to be the biggest risk that you face. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Chris Larsen, what is the biggest risk?
Yeah, so I think everybody's talking right now, Darren, about interest rates and cash flows, and you can mitigate those. You can lock in interest rates. You can set money as you can increase your reserves that you have out there, and those are all good things, for sure. But I think the biggest risk that we face, and we kind of talked about this in an indirect manner, it's people. It's people. Do you have the right people on the team? If you're an investor, are you investing with the right people? Are you investing with somebody who's just a sole operator, without partners? What if something happens to them? Obviously, I'm acutely aware of that. I lost my father at age 5. I lost my best friend in college at the age of 18. So I know that, that there's things you need to put into place. So things like life insurance, estate planning are probably more apparent to me when it comes to that. But if you're an investor, I would ask that question. I would say, hey, Chris, how are you addressing this issue? How is the team built out? So if something happens to, that fantastic operator that you have that came from the medical production facility, how's the team structure if something happens to him? Where's the point of failure when it comes to that? What we do, we put systems in place. So I really like kind of the methodology of optimizing the solution and then automating that solution and then ultimately outsourcing that solution. So again, that's optimize, automate, and outsource. And if you do that, that doesn't mean you release control of it. But after I optimize or engineers say iterate, right? You iterate, you get better. And then you figure out how do you automate that? And oftentimes with automation, it's bringing on technologies that may be better than people. So we have certain technologies that we use, like our CRM system, where it automates responses and it's able to check logs, and then it's able to say, okay, did we check this box for Darren? Yes or no? And then maybe it moves it to an individual so that a human can address that situation. And then finally, that outsource piece. If you can automate something and then outsource it, that means that, if something happens to me, then my partner or one of our employees can address that situation. And I think that's really important because it handles two situations. One, immediate downside risk, Darren, but it also reduces your upside risk. And what I mean by that is as you scale, quality can go down. So how can you scale a business but increase the quality and increase the benefits that you get from scaling? And I think that is really, talking about the risk, but also talking about how you can use that as a competitive advantage as well.
No, that's awesome insight. I appreciate you sharing that. Hey, Chris, where can the listeners go if they'd like to learn more or connect with you?
Yeah, I mentioned earlier, if you want a free copy of our book, Next Level Income, go to our website, nextlevelincome.com. Not only can you find the book there and get a free copy by putting your address in, but you can also find our blog, you can find our podcast. And if you did hear what I said today and you're interested in learning more about our investments, click on the invest link and you can schedule a call with our team and learn more about what we have going on.
Awesome. Chris Larsen, I can't say thanks enough for taking the time today. I've enjoyed our talk, learned a lot, and look forward to doing it again soon.
Darren, it's been my pleasure. Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.